last week, one of the big stories has been the move in yields, and particularly it's been the longer dated yields like the 10-year. Now, it's not broken the highs that it's already made, but it has been moving quite significantly towards those highs. And lots of people who like chart patterns are saying this is a pennant, it should take out the highs and then move on to maybe the 5% region on the 10-year yield. We've also seen a re-steepening of the yield curve, so the 2-year versus the 10-year, because this has been a story about those longer dated yields more than it has the shorter dated yields, though yields pretty much everywhere have been going up, and this could have some significant ramifications for the market. Now, what's the reason behind this move? Because a lot of it is probably due to this massive issuance that is expected by the end of this year. It could be up to $1.9 trillion worth of new issuance from the Treasury. There has also been some fears of inflation picking up again, because we've seen some of the commodities moving higher. And then we've seen this move in the yield curve, which I mentioned, it's a re-steepening. And a lot of people look at a re-steepening and say, that's a re-steepening, then we get the recession. That really looks back at the era of moderation, when that re-steepening was caused by 2-year yields falling relative to 10-year yields. 2 years falling as interest rate expectations were cut and the Fed itself started cutting. What we've seen recently is a bear steepening. That's when those 10-year yields are moving higher because 10-year bonds are selling off. Now, that's very unlike what we've seen in this position over the last 30 years, where you see the yield curve start to move up ahead of a recession. Perhaps we're in an era which is more like the 1980s and the 1970s, where you saw a lot of volatility in the yield curve around those recessionary periods of 1980 and 1982. And if we look back through the early 70s, when we look at both the 2-year, 10-year and the 3-month 10-year curve, you can see a vast amount of volatility in the curve during that era of inflation. And that's because sometimes the Fed would be hiking rates a lot higher than expected. And when you hike rates enough, growth expectations and inflation expectations will eventually fall. And that's your 10-year yield moving on the way down. So you get all this big movement in that 2-year, 10-year space. And it feels like we could get that again, because in both the sort of early 70s and 82, you often saw the yield curve actually invert. That's going more and more negative actually into a recession. So I think we shouldn't rule out the possibility that we're going to see a lot of volatility in that yield curve as we try and work out whether yields have to go up more or the Fed has to tighten more aggressively and kill that growth. And what does this mean for assets? Because that's the real key, is that we can all try and predict recessions, but what really matters is what's going on in asset markets. Now, we're talking about yields going up, but if we are talking about a recession, well, historically, yields have always gone down through recessions, but again, they've gone down through recessions in that era of moderation. Whereas going back to the early 80s, again, we saw yields going up significantly into recession before they rolled over, but roll over nevertheless they did. So if we are seeing yields going higher, is it going to be a significant move higher or a very short window in which those yields move up before they cause problems like tightening that causes other risk assets to roll over? That brings us on to what should happen in equity markets, because as we highlighted last week, equity markets normally have a tradable low in the midst of a recession. But recessions always require unemployment to be going up significantly. We've seen that in every single recession, and so far we've got unemployment that's close to historical lows. Though we are seeing revisions to non-farm payrolls all coming in lower, because remember, for that last year period, non-farms nearly always beat expectations on the upside. But now the revisions are coming in, they're tending to be reduced back down lower again. So maybe we are seeing a retrospective weakening in the employment market, but as we currently speak, initial claims might be turning higher. And yes, we may have seen a low in unemployment, but we haven't seen either of those move in a way which is normally a precursor to a recession. And remember, when we're talking about recessions, when we look at that research from Deutsche Bank from last week, the sweet spot for recessions is still actually ahead of us based on the previous 13 recessions between the first rate hike and then the lag to a recession. So the expectations for a recession should always be ahead of us in this part of the cycle. So that goes back to what we should do. Should we be shorting bonds? Many of the pro community might want to, but what if that window is very, very short? So things like TLT, which have been heading lower, that's the ETF, and you might want to buy puts on that, or if you can, you might want to short it. Is that going to be a very short-lived trade, because a sudden move higher in yields could actually break the back of risk assets? Well, maybe that's not the thing to do. Maybe we need to look at some other parts of the market which might have a bit more longevity than that. One of the areas which has historically performed pretty well into a recession is actually the energy stocks versus the broad market. So when we look at things like the European energy sector, the SXEP, Stoxx 600 energy sector, its ratio versus the Stoxx 600 In 3 of the last 4 recessions, the 3 common or garden recessions, the SXEP, the energy sector, outperformed significantly through the recession. The one that didn't work was 2020 COVID, but that's because we locked everything down and people stopped using energy. But all the other ones, they didn't stop using energy, and actually these stocks tended to outperform. But remember, this is a relative trade, not an absolute trade. In absolute terms, sometimes these stocks would also have fallen. And of course, please remember that none of this constitutes investment advice. This is purely for engagement and educational purposes only. And another area to perhaps look at is gold. And gold actually performed remarkably well considering we've seen real yields going higher. Normally when we see yields going higher like this, you'd expect gold to come unstuck, but actually gold has held in pretty well, not far below those all-time highs of 2050 to 2075. When we look at the chart pattern here, it's a very exciting chart pattern for some people. It's a cup and a handle with basically three highs at that 2050, 2075 level. So we're looking for that to break, and normally gold does pretty well when real yields are falling, which they're not at the moment, or when we expect more fiat currency printing. And if we are thinking about recession, and whilst we might be thinking about the Fed doing more tightening here, once you get to a recession, you should expect the Fed to turn turtle and basically start to loosen again. So perhaps setting up maybe for a 12-month trade through the options market, because volatility is relatively low in the gold market. You might want to buy some calls on gold in anticipation of it potentially breaking. So what have we got here? We've got this scenario where yields have been going higher. They could break the highs, but will it be a short-term squeeze higher in yields that breaks the back of the market? Or are we already due a recession set in stone by the Fed tightening over 12 months ago, 16 months ago, but we're still looking for that window where we hit that recessionary period? Is it going to be a big recession? Well, the part of the problem there has been that we've seen this rolling recession. We saw small businesses getting hit quite dramatically at the beginning of last year. We saw University of Michigan consumer sentiment at levels that has always been coincidental with recessions at the beginning of last year, but we didn't have a recession. We've been seeing pockets of recession in different parts of the economy, but not all at the same time. That might mean that if we do get an equity sell-off, it's not as deep as we've been used to in, let's say, 2000 or 2008. So that's why we might want to play it through some of these spread trades rather than playing it through the outright market. It might be that we end up with one of those equity experiences like we saw in the early 80s or in 1990, where the tradable low still existed, but it wasn't a dramatic low. Maybe the dramatic move has been behind us already. We mentioned last week one other trade, which is moving into cash and owning calls on the market. That gives you a little bit of gunpowder, as it were, if the market rolls over. But basically reducing some risks or some of those relative trades may be the way to play this, because yields moving higher could be the thing that finally rings the bell on risk assets once again pricing in for a recession.